going on with Lady D today? I'm your host, Lady D. Join us every Thursday at 4. Well, good afternoon. I am Lady D with what's going on today. We are located right here at the beautiful studios of KAZ Radio TV Network, 7100 Euclid Avenue, located right inside the Baker Electric Building. And today we have our wonderful guest, no other than the Tax Man. And I'm going to give him a little theme song. Dun, 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 dun. James Oliver, welcome, James. How are you? Happy New Year.
Happy New Year. Thank you for having
me. I know that might not have been all together to be, but you know what I'm talking about
Yes,
when the
ma'am.
tax man come knocking on the door. Yes. All right. So, James, for our audience who are, that's not aware of who you are and what you do, tell our listeners something about Mr. James Oliver.
Okay, James Oliver. I have a company called JC and Associates Tax and Financial. I am also an enrolled agent, a money coach, and a proactive tax strategist, and been doing this now for over 20 years.
That is truly awesome. And so let me ask you, why did you choose this field out of all the professional fields?
I think taxes and money management. I think as a whole, there are a number of people who don't manage money very well. You're not really taught money, how to manage money in school. Even as an accountant, I graduated with an accounting and finance degree, and there was still a lot of things that I didn't learn in my schooling, and some things I had to learn outside of schooling. So knowing that what I had to know and learn, I see this all the time with people who are struggling financially, who don't know the tax system and how to make it work for them. So I said this would be a great field to help people and to get into, to tell people to become financially independent, debt-free, and people say, well, how come only the rich can have these tax advantages? And that's not true. We can also have the tax advantages. We just have to be schooled on it.
I see. So let me ask you, so what is our obligation when it comes down to filing taxes?
Our obligation is to pay the minimum amount of taxes legally possible. We are not expected to pay 1 cent more than we are legal have to. And so if you are paying more than you should, it's not because of what the government, it's just because of ignorance on your part or ignorance of your tax preparer. So, but it is a situation where the more education you have, the more knowledge you have, the better off you will be.
So now, when I come to see my tax preparer, what are some of the things the items I should bring or have prepared to bring to them in order to do my taxes? What are the basics?
Well, the basic things is depending on your situation. If you are an employee, then one of the things obviously you have to bring your W-2s. If you have done some monetary transactions during the year, let's say for an example, you needed some money and you pulled some money out of your retirement, then that's a taxable event. If you have rental property, that's a taxable event. If you have your own side hustle and you're paying people, that's a taxable event. So those are the things that you need to bring to your account. You need to bring all the income, all the expenses you incurred. You also, obviously, you want to keep good records in doing that, because a lot of times people will be in their business and then at the end of the year they'll say, well, I know I made maybe X amount of dollars. I said, well, where are your receipts? Oh, James, I didn't really keep my receipts. Well, how were you supposed to expense and write off these expenses if you didn't keep them? And because of technology, we have a lot of great ways to help us keep receipts. For an example, there are apps that will keep, you just put it in the app. That way, if you lose the receipt, the app has it. And so I would recommend people to take advantage, because just about everybody has a cell phone, And so there are many, many apps out there that will help people keep records and keep receipts.
And may I ask, so how long should one keep their tax records?
Uh, Normally, it's about 3 to 5 years. However, if you have a rental property, you probably want to keep your taxes as long as you have the rental properties.
Okay. And then tell me about your JC tax services. What other services do you provide?
We provide a number of different things. One of the, besides just doing taxes, the biggest thing in terms of being able to pay the minimum amount in taxes is tax planning. And tax planning is not coming to me on April 15th and saying what kind of deductions I can get. And so what you want to do is tax planning starts right now. So if you want to start paying the lowest amount of taxes for 2024, it starts today. It doesn't start at the end of the year, but you plan your finances, you plan your strategies, you plan different activities around your taxes. For an example, if let's say I want to go to Florida and I have a business, maybe if I can find a way to go to Florida, maybe take a tax class, or maybe do some education, I can combine my business with my pleasure, and so now I can write off my trip to going to Florida, versus just going to Florida and not be tax deductible.
So you can do that with your lunches and your gas and different
Sure.
things like that, but keeping those receipts
Yes,
because
yeah.
that's what's important.
It's very, very important.
Because if you get audited, they want to see that.
Yes, I can truthfully say I've been audited a couple times from the IRS, so I would know personally what it is to keep and manage your taxes and your receipts. And in fact, the second time around, I had a gal who was a very, very experienced IRS person. She had been with the service for 30 years, so I know she wasn't new. She was a little bit disappointed because she had asked for several different promotions and didn't get them. So I know that there was a little bit of sourness because she was disappointed that the service didn't promote her like she wanted. So I think she was just kind of buying her time
Okay.
so she could get out. So in the audit, one of the things that happened was that they wanted to audit my travel. And like I said before, I planned my vacations around some kind of taxable event. And I had a situation where I had two seminars. They were about a week apart. And so and they were both in Florida. One was in like maybe, I forget, maybe Daytona. The other one's another part of Florida.
Okay.
And so instead of going back to Cleveland and coming back to Florida, I just stayed in Florida for the whole week. And so when they saw that, they said, well, I don't understand why you were. So once I explained to the person why, I said it actually would be cheaper for me to stay here in Florida than to go to Cleveland and come back. And the person understood that. And then also I showed them, here is the seminar I went to. Here was the seminar speaker. Here were the topics. Here was the registration fee, my plane fee, and bam.
So you kept all your proof.
All of my proof. In fact, the funny thing about that situation was, I got there about 9 o'clock, and about 10:30 we were done. And so the auditor said, Mr. Oliver, I'm really, really surprised. I said, why are you really surprised? He says, well, you were extremely organized with your tax stuff. In fact, I figured we'd be here till 3 o'clock today, and I was going to schedule another appointment with you for another day to finish up our audit. And so here it is, 10:30, and we're done. And I said, well, I'm an accountant. This is what I do. He said, Mr. Oliver, my specialty is with accountants. And so you are the exception. Even with other accountants, they're not as organized as you are. And so I said, well, I'm not sure what you're going to do. You may want to have an early lunch, but I know I'm leaving here. But it was just a situation where I had everything very well organized. I gave her a copy of the receipts. I had a copy of the receipts. I said, where you want to start? Had everything explained. And like I said, in an hour and a half, I was leaving.
That is just awesome. So it pays to stay up on top of everything you have, all your papers, your receipts.
Yes.
And especially if you are a business owner.
Absolutely.
Even small business owners. Let me ask you, so what changes should we be expecting for 2024 this year? Any new changes coming about?
Yes, one of the biggest things that's come about is something called the Corporate Transparency Act, and that's became effective January 1st of this year. And what is that? What is that? Basically, what the IRS wants us to do, I'm just going to just kind of read this to you.
Okay.
It says the laws created a massive government database containing the identities and contact information of defined small corporates and LLC beneficial owners. And so what they want to know is they want to know who are the people either controlling or owning these businesses. So if you have an LLC,
Yes.
you need to report to the IRS that you have one. And so the reason why they're doing this, the government, law enforcement, and security agencies will be using this information to help combat shell companies, that the companies that really don't exist, that just exist as a shell, or that engage in money laundering, tax evasion, terrorism, and other crimes. So that's why they're trying to create this database for everybody who does that. Now, if you created an LLC in January of this year forward, you have 90 days to make this report. If you have an LLC that existed before of January this year, you have to the end of the year, you have a whole year to report this.
Let me ask you, so how do I go about reporting it? Is it through my tax preparer, or do I just reach out to them?
You can go through your tax preparer, or you can go, to comply with the new law, here's what you have to do. You have to file what's called a beneficial ownership information report with the Department of Treasury Financial Crimes Enforcement Network, which is called FinCEN. And so you could go to the IRS.
Say that one more time, because
Okay.
somebody didn't catch all of that.
All right. So you have to report to the Department of Treasury Financial Crimes Enforcement Network, which is also called FinCEN. Okay. Which basically is an agency under the federal government where you actually report this information. Now, here's the thing that you have to kind of remember. If you don't report it and someone says, well, now here's two things. First of all, if you have an LLC, now an LLC that's been registered by the state, now if you just open a business and you say you're an LLC, but you never really registered with let's say the state of Ohio,
Okay.
then you're not really required to file.
Okay.
However, if you went through the aspects of going through the state and being registered with the state, getting your EIN number, then you do have to register. And it makes no difference whether you start business or you don't have, or your business is active or not. You still have to report. For an example, some people will have rental properties. So if someone says, hey, I just got this one rental property under an LLC, and the reason why I have this LLC is because my attorney told me about it, do I have to report? The answer is yes. And so, and let me step back for a second. The reason why people get LLCs, the primary reason, is not an accounting strategy.
Okay.
It is a legal strategy. The reason why you get an LLC or limited liability corporation is to protect your business assets from your personal assets. And so it's a decision that you need to make if you're in the business of doing something where there is a possibility that you could be sued, then you want to get this LLC. For an example, if I was in the business of making football helmets for Little League people, there's probably a good possibility that someone, little Johnny, could get hit and have a concussion, and so now they want to sue me for that business, and so I want to protect myself from that liability, so that's why I formed the LLC. Now, on the other hand, if I'm trading in the stock market, do I really need an LLC? What's the probability of me getting sued? Probably very, very small.
Okay.
And so I probably really would need the LLC. But sometimes people say LLCs because that seems to be the fashionable thing to say these days.
Yes.
And so there are some exceptions. If you have an LLC and you have more than 20 full-time employees and your gross income is over $5 million, then the government is not, they figure they can get to you some other different ways and they don't need that information. And so if you're doing that well, then you really don't have to do this FinCEN reporting. But if you have, like I said, just one LLC for a piece of property, or you've got 10 properties in 11 different LLCs, you have to report each one of them. And so the government is not just asking you to do this, even though they are asking you to do this, but there are consequences. If you don't file this thing, there are civil penalties up to $500 per day.
Lord have mercy.
Okay, a criminal fine up to $10,000. So you got a civil penalty, you got a criminal penalty. One's for $500 a day, and for the criminal penalty, it's up to $10,000. And you could be in prison for up to 2 years. So the government's not playing with this. This is very, very serious.
So this information has it been announced? You know,
It should be announced.
because this is my first time hearing of it. You know, from you, and I'm quite sure there is a lot of, and we've got a lot of LLCs running around here.
Hmm.
You know, so this is really important. If you are a small business owner and you got a LLC, you need to do this within 90 days
No, no. If you have an LLC that you started this year,
this year.
you have to do it within 90 days. But if you had an LLC before this year,
Yeah.
then you have to the end of the year, December 31st.
Oh,
So you've got
okay.
a full year. But you know, obviously, people who are forming new companies now,
Right.
the government say, hey, you got 90 days. So if you file one, let's say January 5th,
Yeah.
okay, you got 90 days from January 5th to April 5th to get that filed of this year.
Okay.
So versus, let's say, if you started a corporation last year, 2 years ago, 10 years ago, you have a full year to do this.
I
And
see.
so one of the things that you have to kind of keep in memory with this thing is that this Corporate Transparency Act is not it's not part of a tax law, and it's not enforced by the IRS. And so it's something that is, even though it's under the government and Department of Treasury, it's not something that the IRS, this is another part of the government that's enforcing this.
Oh, okay. So this is separate from the IRS department.
Yes.
Okay, so let's talk about what's going on with the Cash App. I know they're monitoring that.
Yes. Okay. So there's been a little bit of a pass on that, so to speak. Here's what the situation of the government. You know, the government's always trying to find people who are not reporting their income, and because of that, they're looking for all kinds of ways to see. You know, and that's why, for an example, if you have interest for more than $10 on your account, you know, let's say savings, that the bank is going to report that to the IRS. If you're doing transactions through your stock brokerage account, that brokerage firm is going to report that to the IRS, because if you don't, then they'll send you a little letter saying, hey, Mr. Taxpayer, we noticed that you had some interest on your bank account that you didn't report, or you sold stock for this amount of money and you didn't report that. And so what they've come up with, and a lot of in the new age of now, especially in the area of, let's say, barbershops, nail techs, hairstylists, instead of paying people, giving them cash, they say, well, you can just pay me with your Cash App.
Right.
You can Cash App me, you can Venmo me, you can Zelle me.
Okay.
Okay, and so, and people are not reporting that. And so what IRS has decided to do was says that if you have more than $600 in a Cash App, then they're going to issue a 1099-K to make sure that if you didn't report it, they're going to come back into you and says, we noticed that you had $5,000 in Cash Apps that you did not report to the IRS. But now here's the problem with that. You know, and maybe I'm sure you know this, but I also work as a tax director for another accounting firm
Okay.
called CLE. And so on occasions, I may go to Slimans and say, I'm going to go to Slimans, and does anybody want anything from Slimans? And people say, yeah, I want this, what's this? And so I go get my sandwich, and then if there's 10 other people, I might pick up 10 other orders.
Right.
And so half those people may, or maybe even all of them, may want to cash at me for their order.
Right.
Okay, so if I do that a couple times a month, in a year's time, I might have $3,000 or $4,000. But remember, that's not income to me. That was just reimbursement for lunch.
Right.
Okay, and so, but the government doesn't know, and that's what they're trying to work out. For people who are in my situation where I'm being reimbursed just for lunch,
Right.
versus the nail tech or the person who is doing the hair and who's receiving Cash App, or even contractors. Contractors may pay their subs by Cash App.
Right.
And so that's what they're trying to work out the bugs right now. But if you receive in Cash App of more than $10,000, you will get a 1099-K. So regardless of what you do, and so if it's just expenses, then you have to explain what that amount is. And so right now, like I said, they have suspended that because they want to do the threshold at $600, and because they couldn't work out all the bugs, they said, well, maybe we'll start in 2025. And so that's one of the things that, so be careful. That's it. If you're not reporting your income and you're receiving Cash App and you are, like I said, in the business of receiving, just be on the lookout that the government is going to fine you if you're using Cash App or you're using Venom or if you're using Zelle. That's coming down the pipe.
And this is for everyone. This is not just for business owners.
Right, because remember, the IRS doesn't know whether if it's
Okay.
just reimbursement. All they know is that you received on your bank account, X amount of dollars. They don't know if it's for business, if it's for reimbursement. They have no idea. So then what you have to do is, if in my case, I would have to explain and actually say, okay, I received $3,000, but because this $3,000 was just for lunch reimbursement, there's a way to report in the IRS and for them to say, okay, we understand that's what it is. But if I just skip it all together and saying, hey, I don't, I know I wasn't in business, then and don't report on my tax form at all,
Right.
then the IRS is going to send me a letter saying, well, we noticed that you received $6,000 in payments, and so we just assumed that's business that you just forgot to report it to us.
They're always watching.
They're
They're always
always-
in your pocket.
Yes.
There's no winning with them. I tell you. Don't you have anything else to do? Let me put you to work. Let's give them another type of job. Okay. So let me ask you. So when should someone start thinking about increasing their retirement plan contributions?
When they get started working.
Okay.
Because you can really never have too much money in retirement. It is impossible. And if you actually somehow had too much money, come to me and I can help you spend it. But the problem is on the other side is that when you have people who are now, in fact, I said something in one of the social medias and saying that the average net assets of people in their 60s is about $319,000, and that's including their house, which means basically they may only have saved up maybe $250,000. And if you're retiring with only $250,000, $300,000, and you don't have a company-sponsored retirement plan, and all you got is Social Security, you will not have enough money. You will have to keep working unless you have some other ways of being able to have a slim way to live on. And so my suggestion is this, is that when you start working, that you want to average about 15% of your pay into your retirement account. And so obviously as you get raises, you keep that 15%. Now, if you're starting late, if you're not in your 20s and your 30s, you may want to increase that to maybe 20%. If you're starting in your 40s, you may want to increase that because there's a certain amount that you want to have that's going to take some time to build up.
Okay.
And so you don't want to start at 50, because then it's not that it's ever too late, but it's just that means you just have to have a longer time to catch up with, and you need to put more money in. So the earlier you start, the fewer dollars you need to get started with.
I see. So now tell me, is it true that a Roth IRA conversion allows workers to convert to a traditional IRA asset to a Roth?
Okay, I think probably a better way of saying this is that, well, a couple of ways. When you do retirement accounts, the traditional way is what's called tax deferred. So, for an example, if you are putting money in your 401k, or if you open up an IRA account, and so the money that you put into that account is tax deferred, you don't have to pay taxes on it now. It's that when you pull it out, it's when you pay taxes. Now, the benefits of having a Roth versus a traditional account is twofold. Now, the negative side of it is that when you put money into a Roth, you do not get a tax deduction at that time.
Oh,
And so
okay.
that's the problem. So let's take person A and person B, and let's say one puts money into. They start off with, they put in an average of, let's say they build their account to $500,000, but one's in a Roth account, one's in a traditional account, and so the person who put, excuse me, the $500,000 away for their retirement account in the traditional, and let's assume that they're in the 25% tax bracket, they would have received in discounts over the years in a cumulative amount of $500,000. I mean, I'm sorry, 25% of let's say it'd be about $125,000.
Okay.
Gets about 25% of that, and so let's say that money grows to $1 million. Okay, and so let's say the person B who had the Roth account, he put that money away, had $500,000 he put away. Well, unfortunately, he's not able to deduct any of that. Okay. In the beginning.
Okay.
But let's make it a little more juicier. Let's say that $500,000 becomes now $3 million. That they put it both in the same accounts.
Yeah.
And they both grew $3 million.
Okay.
Okay. So now let's go with the person who wants to start taking that money out. Now, if they're still in the same 25% tax bracket, now they have to give the government back $750,000.
Okay.
Okay, of that money. So they said, well, okay, we did a good job because we gave him 125,000 in tax deductions, but he's giving us back 750,000.
Wow.
So we did out pretty good with that guy. Now the guy who did the Roth, who did not get the tax deductions, he can take that full $3 million out,
Right.
no taxes.
Oh, that is
Zero
really
taxes.
nice.
Now, if you're going to do what something is called a Roth conversion, let's say you have a traditional account and you say, hey, I want to put my money into a Roth. At the time that you convert it over to a Roth, you have to pay the taxes on it. So if you have $50,000 that you now want in a traditional and you want to put it into a Roth, that $50,000 becomes taxable right at that time. Now, the benefit of that, even though you're paying taxes at that point, if you're expecting that money to grow like crazy, well, everything you earn after that point will be tax-free. So if you just put that $50,000 into an investment, and that investment comes to $5 million, there's no taxes on it. You paid your money up front, and whatever you earn on it is tax-free. So that's the benefit of the Roth conversion. Like I said, you have that little sting in the beginning,
Right.
but whatever it grows
pays
to,
off.
it pays
It's
off.
well worth being patient and letting it grow.
Absolutely.
Wow, Mr. Oliver, you have so much information to share. We're not going to give it all to you today because he'll be back next month. And then the month after that, I can't promise you April. So you better get your pens and papers out and take notes. And Mr. Oliver, please give our listeners your information, how they can try to get an appointment with you.
Okay. It's once again, the name of the company is JC and Associates Tax and Financial. I can be reached at 216-491-9350. Now, if you have a much bigger company, something that I probably may not want to handle, you can reach me at CLE Consulting Firm, and their number is 216-800-9021.
Awesome. Give it to him one more time.
Okay. My business is 216-491-9350. That's JC and Associates. And the other business is CLE Consulting Firm, and they can be reached at 216-800-9021.
Excellent. So now you know what's going on today. Thank you so much, Mr. Oliver, for coming and sharing this wealth of knowledge with all our listeners. And now get your finances in order because we got money, 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 money. Money. All right.